Okay, welcome everybody to our 15th webinar, Holmquist and Gardner. We are a business and real estate law firm focused exclusively on business and real estate and things in those subcategories, little construction. Half the firm litigates, the other half, led by me, does transactions. And today we are super excited to talk about residential financing, the COVID update. We have with us today very special guests that I've known for many years, had the opportunity to work for on behalf of and with clients. Garrett Frol. Hey Garrett, how you doing?
Hey Imants, thanks for having me over here with you guys.
Garrett started in the residential mortgage world roughly 20 years ago, then working for a number of firms, and for the bulk of his career, he's been at his current company, Evergreen Home Loans. There's a lot of options out there, and we're going to get into sort of what the world of residential financing today, and talk a little bit more about what it means to be a residential broker. But as with all of our webinars, we try to get people on that have industry expertise that we don't have. We're doing the legal side, and although we do a lot of work with financing and drafting and reviewing financing documents, the marketing of that and obtaining loans and doing all that, that's in the residential space. That's guys like Garrett. So we're super happy to have you, Garrett. Thanks for joining us.
Thank you.
So getting right into it, we're going to talk first about sort of this pandemic adventure we've all been enjoying. So maybe just take us sort of the trail through the wilderness of 2020 and the pandemic to now with, the impacts on the residential mortgage sector.
Absolutely. Yeah. So ended 2019, leading into early 2020, pre-COVID, business was good. Everybody was excited. Deals were coming through. Rates were still very competitive at that time. At the end of 2019, early 2020, 30-year fixed rates were, high threes, low fours, like really good, not high enough to have any real impact on the housing market. And then March, COVID hit, and all of a sudden we saw some stuff that scared lenders pretty big time. The first example that I'll jump into was the jumbo loan sphere. As soon as COVID hit, the shutdowns happened, the case numbers spiked. Jumbo lenders essentially pulled out of the marketplace. There were people in process trying to buy a home who had their loans approved, ready to go. These jumbo lenders said, no, pump the brakes. We're not gonna send you any money for this home purchase because we're not sure what the world's gonna look like. And so that sent everyone in a panic. And lenders inherently are very much risk adverse. And so when there's anything that is going to throw a kink in the process, that kink sticks pretty hard. And so these jumbo lenders shut down. A lot of the big banks stopped offering what would be more riskier products like adjustable rate mortgages or HELOCs. So people couldn't even go get a line of credit on their house, which is pretty crazy. And that really dried up a lot of the business for a lot of these big banks and smaller community banks also. They just weren't sure what was going to happen, and they didn't want to have anything on their books that could potentially be at risk of default, foreclosure, or anything like that. And so, for about 4 to 6 weeks when COVID really first hit, those products really went away. And that meant there was dry financing, which means no financing for a lot of those products for a period of time. Since then, when we started back up into summer of 2020, jumbo loans came back, but with that were massive caveats. These jumbo lenders put massive guideline restrictions, COVID restrictions, they call them, on the underwriting requirements. And for example, people that are self-employed, the self-employed people, even still today, are run through the gauntlet to obtain financing. Before COVID, all you really needed to do was supply your last 2 years tax returns, and if you got stable income, here's your loan, we're good to go. Now, not only do we need your last 2 years tax returns, but we want to see how you performed through COVID. And that means getting business bank statements to see deposits to show income really kind of still coming in the door. They want to see a profit and loss statement, and balance sheets that are year to date and accurate to reflect the deposits that are showing on your banks on the business bank statements. And those can be tricky, and then in different spheres, like commercial real estate agents, that business dried up too. And so those folks who are trying to obtain mortgage financing were really challenged. And so we're slowly starting to see some of this stuff come back. I bet you if I was going to put a number on it, I'd say we're about 50-60% back to where we were before. The other thing, that happened with COVID were the PPP loans, and most small business owners took advantage of those. When you're qualifying for mortgage, we take that PPP loan right off the top of your income analysis. And so if you took a $250,000 PP loan that for qualifying incomes that shows on your profit and loss statement, we're taking that off of qualifying. And so that can really be a detriment to people. But like I said, we're slowly starting to see things come back to normal. And hopefully the Delta doesn't disrupt things again and throw us back into the spin cycle. But we're moving in the right direction. And business is good. Rates are still super competitive. The housing market, as everybody's probably pretty aware, is red hot. And so we're moving in the right direction. It's still a challenge. The other point, with forbearance and student loans, people would go into forbearance on their mortgages. That worked great for a lot of folks because if you had a job loss, you didn't have to make your mortgage payment for a period of time. What happens now, though, is once you're out of forbearance or you decide you want to start making your payments, you have a new job, you're ready to go and take advantage of the interest rate environment that we sit in currently, we've got to prove that you're caught up on your payments. And so some of these folks who have not been caught up, they've got to wait a period of time before they're going to be eligible for new mortgage financing. And the last point there with student loans, many people have student loans and some of them are significant. And all federal student loans are still in forbearance. So on your credit report, they show a zero payment. Mm-hmm. But that means, though, that there's still outstanding debt that we have to qualify you for. And so some jumbo lenders particularly will make you qualify at 1% of your outstanding student loan balance. And so A lot of folks, which is a big number, right? So a lot of folks will have, a $200,000 student loan because they went to medical school or they went to law school or they're paying off their undergrad. And now they want to buy a house, but their student loans showed $250,000. Now we've got to qualify you with this massive payment, which really isn't factual because you're not really paying that much. But that can throw a wrench into the qualifying scenario too.
Yeah, I think we saw a number of deals on the residential side that had snags that were unusual, where it felt like this is just a normal deal. This shouldn't have had any hair on it whatsoever. And they did competitive offers. They still were having these bidding wars. And we just kind of got held up, and in scenarios where people are extremely creditworthy, and it just seemed like unnecessary underwriting. Sometimes, that's just the way it goes with the cell phone businesses or sole proprietors and things like that. That's always a mess. Another thing we were kind of talking about yesterday was any impacts for underwriting the rental housing where you had either separate entity or not, or if you had COVID tenants that were not paying rent, any impacts from that?
Big time. Absolutely. Yeah. And it really, when the underwriters take a look at things, it depends on how you file on your tax returns. If you file a simple Schedule E single family home where you rent it and you itemize deductions, those are pretty easy to follow. And then the underwriters want to show the tax return for the past year. And if we've got a current lease agreement, then we're going to be in good shape. The folks where you run into issues with, or when you file a 1065 and produce a K1, those K1s sometimes, and it depends on how you file your write-offs and those things. But those, when you file that way, the underwriter looks at it like a business, not like a rental property. They really now are going to start digging in the weeds and trying to see what's up, what you're reporting. Was there a loss of income at any point? And if there is a loss of income, that shows as a loss or declining income, which, like I mentioned earlier, lenders are risk averse, and that makes them scared. And, we don't want that. We want our jobs to get loans done and get people into homes. But there's some kinks to work through, and trying to have a plan and navigate that the best way we can is how we try and help our customers.
Awesome. So kind of moving in the direction of the current trends, where were interest rates heading into COVID in the last year, and kind of where are they now? Maybe you can walk us through that world.
Definitely. Yeah. So rates before COVID were good. They were performing well. COVID hit. Markets got scared, which when markets get scared, a lot of money gets pushed into the bond market. And that drives up the price of mortgage-backed securities. And mortgage-backed securities and interest rates work inversely of one another. And so the more money that's going into the bond market will drop interest rates. And that's what we saw happen almost right away when COVID hit. And Imants, can we jump to the other slide so I can show the?
Yeah. There we go. Maybe one more slide. Here we go.
Yeah. So what we can see here in 2020, the beginning of 2020, there's it looks like probably a quarter of the way through 2020, there's a spike. And that's what happened when COVID first started. People kind of freaked out. They weren't sure what's going to happen. There was a drop in the stock market. Interest rates spiked really quickly, and then they started coming down. And as you can see, from about the first quarter of 2020 down into where the beginning of 2021, that's when we saw record low interest rates. And they've been performing really, really well ever since then. We've had a couple up and down moments. And now with Delta, we're starting to see rates come back down again.
Yeah, awesome. Good to see a chart like this that kind of gives the long-term history of where we're at. And then I think we have another chart talking more about how the consumer mortgage-backed securities drive this.
Correct. Yeah. So if we take a look where January 2020 is on the x-axis down below, what we see here is the price of mortgage-backed securities. And this is me nerding out. I just love this stuff. So what we see here, January 2020, I'm using my fingers to point at the screen, which obviously nobody else can see what I'm doing. But you see this just massive rise in mortgage-backed securities that happened all of a sudden, and that was money flowing into the bond market. And then rates just went plummeting, and record lows, millions of people refinancing. Great time to be in the mortgage business. Everybody was busy, doing really well. Unfortunately, like we mentioned before, some people were left out to dry, hung out to dry with self-employed folks.
Right.
But we did see able to help hundreds and hundreds and hundreds of folks get into lower rate mortgages, move them from a 30 to a 15-year fixed, because their rate went down by so much, and you got to shorten your term, and that worked really well for people for interest savings. And so what we see here is through the beginning of when COVID started, then through the first part of 21, that's when we saw rates kind of stabilize a bit, and we're still in that same category right now.
Great. Yeah, this is extremely helpful. So let's move one more slide forward and just see, because I think we had another indicator. Yeah,
this is my last geek out real quick. So this is when the first quarter of 2021, when the stimulus package was announced, that we saw the price of mortgage-backed securities almost overnight, well, it was more about a week, plummet. And what happens there is when mortgage-backed securities plummet, rates go up. And what happened when the stimulus package occurred, there was many folks were really worried about inflation. Inflation is the killer to bonds. Bonds don't like it because it's a fixed asset for a certain number of years. And so as inflation ticks up, the return on that fixed investment goes down. And so what happened is we've been reading throughout the process here is that this inflation that everybody was worried about turned out to be transitory. And that's what most people are telling us right now. There was an influx of money into the economy, and it got used, and that money doesn't exist anymore. And so now we're kind of flattening back out.
Yeah, I mean, this was, when we were talking about this yesterday, it's incredibly informative for guys like me who aren't geeking out on this stuff. It's like, okay, this is actually really interesting. And it did seem like with the pandemic generally, there was a couple of different scare points. One was actually obviously the inception of the pandemic. And then the second was this, okay, we're going to start pumping money into the economy, which I think through the PPP loans and then now this new infrastructure package had a lot of us kind of sitting there going, okay, I don't know much, but there's always an impact when you pull a different lever of the financing back end of our country and our economy. And it seems like what you're showing us here is that, hey, those levers being pulled doesn't necessarily translate to a detriment for us in the residential mortgage world.
No, and leading into the other conversation that Imants that you and I chatted about, everything that we've been reading right now, rates aren't at the where they currently sit, aren't at the all-time historic lows that we saw like October or August through October of 2020, but they're still really good. And with rates as low as they are, that's it really creates this infusion of buying power for folks. And so that's part of the reason why we're seeing homes flying off the market, these escalating prices and so forth.
Yeah. So, and we'll get into, I guess now is a good time to jump to the time honored tradition and of just, probably the question you get a lot of the time is now the time to refi. How would you answer that question?
And it's a great question. And it really depends on where the consumer is in that moment in time. When you refinance, there's a cost associated with it, and they're hard costs. You're not going to see that money again. We call those your closing costs. That's your appraisal, your title and escrow fees, those sort of things. And so what we really need to do, or your mortgage advisor needs to do a cost benefit analysis for you and determine whether paying a few $1,000s for an upfront fees is worth it for the long-term interest savings on your loan. And some folks, $50 to save every month is different for one family to another, or whatever that number may be. But really doing the analysis and diving into it to figure out what makes sense. We're seeing we did a bunch of refinances last year, and a lot of those were 30-year fixed to 30-year fixed. And people are happy saving a bunch of money on their monthly payments. A lot of the stuff that we're starting to see now are more, rather than just a conscious budgetary monthly savings deal,
Sure.
It's more of a financial planning situation where really looking at what's the best way to save interest on your mortgage over the life of the loan. And so that could, what it's an example there would be somebody's on a 30-year fixed at 3.875%, which is still really good. Well, hypothetically, what if we can get you a 15-year fixed at 2.625%? And your payment's not going to change nominally, but your interest savings will, over the life of the loan, can really create long-term, wealth building for a family.
Yeah, especially when you get up into the, millions of dollars. I assume that obviously those numbers get a lot larger. How about another thing that we talk about when people are talking about refining is just the ease of obtaining financing. It seems like you had COVID and there were some question marks on underwriting. And now some of those question marks still exist, but I think reading between the lines, you're saying it's still readily available, and if your credit's good and you have income and you can document it, like we're not in one of those periods where it's just like really tough.
That's a good question. There are caveats on both sides, right? So let's just throw out somebody that works at Amazon, makes $150,000 a year as a W-2 salaried employee. That is super simple to prove income, verify assets. You sometimes on conforming loans, you don't even need appraisals anymore. If there's enough data in Fannie Mae's system, they'll give you an appraisal waiver. So you don't even need an appraiser to come out to your house to validate your equity. And so those things have really eased the process. For people with variable income and people who have who are self-employed, variable income would be someone who's commissioned, receives bonus, or this is especially true in our area, restricted stock units or stock awards from Microsoft, Amazon, or the other publicly traded companies. Then that's where there's some more digging to get into. But we're being in the Northwest, we're all familiar with how those calculations work. So that's not as cumbersome as some people may think. The process start to finish on a refinance usually takes 30 to 35 days. But there's a lot of paperwork, and you're going to be asked to sign a whole bunch of stuff, and there is a pain point. And so if saving $50 a month or whatever that number is, and there's a pain point associated with it, then you have to kind of cross that bridge and decide what's important there.
Yeah, awesome. This is great insight. And as always on these webinars, we'd like to have a good Q&A period. So now's a good time if you're a participant to use the Q&A functionality of Zoom to just type in questions as you have them. And I have a couple that I get asked a lot that I think would be great if you could just tee off on, Garrett. The first one would be, the primary differences between a mortgage broker in the traditional sense, where you're out broker, getting a lot of different options for clients versus an in-house situation, bank or lender like Evergreen or Bank of America or Chase. Maybe you could just kind of run down the difference in those two approaches.
Yeah, thanks. So there are predominantly 3 channels of business when it comes to mortgage financing. We'll start with the first, which is like a true mortgage broker. The mortgage broker takes your loan application, collects your documents, and then tries to figure out with their approved vendors or lending institutions who the best group to send your information to, and that's a great model. It really is. They can shop around for interest rates and all those sort of things. The caveat there is that once you send off your documents to that end institution, you've lost control of the process a little bit, and that doesn't happen all the time, but now it's in the lending institution's hands, rather, and where you're still the loan officer, but they're the one who's going to provide credit at the end of the day. The next channel is like a mortgage banker or a lender, which is what Evergreen does. And what we do there is we fund loans with our own money. We underwrite in-house. So the process from A to Z stays on premises with us. And so that way we retain control. And then we reserve the right to sell the servicing rights of the loan or retain them. Evergreen ourselves has a large servicing portfolio, so we hold on to most of our loans, but we do sell them off occasionally. The final platform is like your community banks and even your large institutional banks like a Wells Fargo or Chase, and those are great options. Also, they're limited to their one source of underwriting and funding. So if you don't fit in the box there, then you're kind of stuck. So it works great. Banks are great. You know where your loan's going to be serviced. You can walk into the branch and get a mortgage statement. But there are plus and minuses to each route. And it's definitely an interesting question because they're all good models. It's just they're different ways to get to the same end game.
Yeah, and I think that's extremely helpful to hear. And I think if nothing else, if you're watching this, it's just key to understand who you're going with and make sure that if you do decide to kind of take sort of 2 horses to the track, you try to maybe diversify which one, like know who you're going with, and then maybe try and take someone different so you understand that at least someone's going to be in the camp of Evergreen and the groups that are going to hold it all the way through, because that's going to be probably a better shepherding process. If you have a banking relationship directly at a bank, sometimes that can help. In my experience, I've been a little bit surprised where there's a strong banking relationship. That's kind of why you would say I've stuck with this bank for 20 years. But at the end of the day, if they don't have the product or somebody in underwriting in New York doesn't like you as a borrower, that relationship quickly is not that meaningful. Which, I've had a few head shakers in the recent past here. So we had a question come in, and this is definitely for Garrett. Can you please elaborate on how lenders review and account for rental property income when qualifying people for loans? Write-offs and depreciation make the income appear lower on tax returns. Does that affect DTI?
Thank you, Aaron. Appreciate the question. So it looks like you're talking about filing on a Schedule E in those scenarios. So yes, so depreciation makes your gross qualifying income look lower than it actually is. We get to add back depreciation in terms of adding it back to that. Usually you try to write off so it's closer to a zero as you can, we could add back that depreciation to show that income grossed up. And then what we do is we take a look at, I've got a calculator actually, you take a look at, you add everything up, you add your depreciation back in, and then you subtract out your homeowner's insurance, property taxes, and your principal and interest payment to qualify to offset the payment on that property.
That is an answer that I would be unable to give, and that's why you're here, Garrett. We appreciate that kind of detail. Another one was that we received. I've heard there's now a thing called a credit pre-approval. Is that true? And if so, is that better than the old pre-approval letter?
Yeah, good question. So the pre-approval letter or a pre-qualification is, well, there's three different ways to look at it. Your pre-qualification is jumping on the phone with your mortgage lender. You tell them how much you make. You tell them, I think I've got a 720 credit score and I have a car loan. And I've got 10 grand to put down.
Some basics, yeah.
Yeah. And so that's back the napkin at the Met, like just kind of shooting it around with your buddy.
Drinking old fashioned,
Drinking old fashioned, all that good stuff. The next level is a pre-approval. The pre-approvals, we actually do a loan application. We get your data, you ask your social security number, date of birth. We do a credit report, and then we collect your income statements and your asset statements. That's pretty much just up to the loan officer to decide, hey, if they're credit worthy or not. And usually that's pretty good. That being said, in the environment we're in right now, where you need to close in 17 days on a purchase to get your dream home, you need to take the next step, and that's doing the full credit approval. And that's when we still do the same thing, do the credit report, collect your financials, but then we actually send your loan through the underwriting process. So the underwriter is the one that actually already says, no, you guys are good to go. We're going to give you an approval letter right here. And then all we need to do to fund the loan is get an appraisal and a title report on the property, and you're good to go. And so in this competitive environment that we're in right now, that's what we suggest our customers to do, especially if they're serious. Sometimes people just want to know what their purchasing power looks like, which is great. But if you're really going to jump into the market, do your due diligence, take the next step, and get ready to go.
You've seen a pretty high hit rate on those, like
yeah, absolutely.
Like where the success rate is say like in the 99% or something like that for people that have that, as opposed to just a back of the napkin.
Absolutely, Imants. So I would say that the people that go through the credit pull, let's say you're buying a house, you want to put an offer in a house that's listed for $750K, and you want to offer $755, which in this market is kind of tough to do, and you have a credit approval, that's going to put you above and beyond somebody who's also offering $755 who just has a pre-approval letter, because you can prove to them. That being said, if somebody's going to come in and offer $850 and you offered $755, you're probably going, that's not going to get the horse to drink the water. But if you do the extra steps, then you're going to put yourself in a better position to succeed.
Awesome. And you mentioned jumbo loans. I think yesterday I said something like 740, and then you said what is the cutoff right now for jumbo loans?
Well, jumbo loans, for the most, so interest rates, interest rates are derived on your down payment percentage, your equity position, and credit score. Mm-hmm. And so conforming loans, and so in King County, the maximum conforming loan limit is set at $776,250. Anything below that number is considered a conforming loan. If you have a 740 or better credit score, you're going to get the best interest rate. Jumbo loans are more sensitive than that. Jumbo loans, so if you're over 776,250, jumbo loans will then take that incremental 20-point tier in credit scores all the way up to 800. And so if you have a 740 credit score on $1 million loan versus an 800 credit score on $1 million loan, then you're going to get a better interest rate at that point.
Mm-hmm. And 740 is kind of the cutoff. I mean, that's the bar, or 750.
You can do jumbo loans, you can get down to 700, but the rates aren't going to be super great. And a lot of that has to do with the fact that jumbo loans are held on the books, their portfolio loans, and are held on the books of the lending institution. Mm-hmm. And so they price it accordingly. If they're going to lend $1 million, they would prefer to see a higher credit score, because your rates of default are much lower for somebody with an 800 versus a 650.
Okay, another question that actually we get all the time. looking to refi single family residential, have been holding it in an LLC. What are you seeing in that market? Do I need to quick claim it out to do that? Or is there an avenue with most lenders now to do that refi?
That's funny. I actually just talked to our servicing manager about this yesterday for a client. Once you close a loan, it's pretty easy to put it into an LLC. If you want to refinance, you need to jump out of the LLC and quit claim out, because we're making the lender's making the personal guarantee to the individual, because that's who are qualifying, not to the LLC themselves.
Mhm.
But you can put it back in afterwards. I mean, there's of course a cost to do that, but that's why you have good attorneys to make that work. But yeah, so you can do it. There is a sticking point to making that work. There are institutions that will allow you to fund in an LLC, but because you're funding in an LLC, and it's more of a one-off situation, you're going to find that the terms of the loan are not as competitive as if you were funding a loan in the name of an individual.
That's been our experience, is that ultimately it's so in the residential world, at least, if you're not, obviously commercial is totally a different beast entirely. But it just changes the credit risk analysis, I think, on the underwriting standpoint, just a general risk, not just like dollars and cents, but just, hey, there's an LLC just comes with certain risks that most banks are like, that's fine, you're just going to pay for it.
Exactly. Yeah, you can pay for anything.
Right. And we'll see, I have seen recently more avenues. It used to be, 4 or 5 years ago, just a full stop no. I'm starting to see more lenders provide certain forms to allow for it, but it's, to our point here, it's always more expensive, and then there's more paperwork. And I think the trend is toward kind of allowing them, but sort of charging for it rather than just saying no. And there's always, and when you talk about the 3 models, we're of course talking about the 3 sort of normal retail models. There's always hard money financing and borrowing from dad or whatever that are out there that are kind of off the grid, and those really don't apply to this discussion. Okay, so look,
I've got one more thing for you.
Go for it.
We did our outline. So the Fannie Mae and Freddie Mac, who predominantly are lending institutions who make the rules, right? They have recently decided they want to pull back on their rental and secondary home financing market. And so what we saw about a month ago, maybe 6 weeks ago, was that if a lender is sending more than 7% of their business as an investment property, which would be a rental or a second home, and selling those back to Fannie Mae or Freddie Mac, they're slapping you back on the wrist and making you raise your prices, which means increased rates on those loans. But if you stay under that 7% pull through as you sell your loans to Fannie Mae and Freddie Mac, they don't have that same slap on the wrist with your pricing. And so some lenders have stopped doing those loans altogether until their pipelines are dried up with those, and then they'll slowly ramp them back up. But it is really interesting that Fannie Mae and Freddie Mac have decided that lending on investment properties and rentals is not the game they want to play right now. And so some institutions don't have that issue, others do. So if you're looking to obtain financing with your mortgage specialist, make sure you ask that question. Otherwise, you could be paying for something that you don't need to be paying for because another institution is playing by a different set of rules. That's
really good insight. I was not aware that was happening, and I think we're going to hear more about that, because that obviously has some political implications. Federal government, obviously, those are federal institutions backing, trying to encourage housing and home ownership, and also encourage a strong residential rental market. So it'd be interesting to hear how that plan pans out. Okay, so as always, thank you everybody for coming. We're super excited to be able to deliver this stuff. It's obviously for informational purposes only, not to be relied upon for legal advice or advice from your licensed mortgage broker, Garrett, here. You should check with your own mortgage advisor or real estate attorney before taking any actual steps. And we encourage you to reach out to us if you have any questions. This is all being recorded, and so it'll be on our YouTube channel, and you're welcome to pass that around to your friends and colleagues. We really appreciate the opportunity to get our information out to people, and we look forward to seeing you at our next webinar in September. And you'll see information about that in the upcoming email, and you will receive an email with a link to the recorded video of this. So you can have it for your reference or pass it on to a friend. Thanks, Garrett, again for joining us. Really appreciate it. Thanks
you.
everyone for joining us.
Thanks, Imants. Have a good one, guys.
Have a good one.
Bye-bye.